Whenever you're ready, Madam Treasurer.
Good morning, Representative Berger and members of the Finance, Revenue, and Bonding Committee. I want to thank you for the opportunity to give testimony in support of Senate Bill 1133, an act concerning the treatment of bond premiums under the State General Obligation Procedure Act. I strongly urge the committee's endorsement of this bill, and I commend its leadership for bringing it forward. This proposal represents a compelling opportunity to more effectively manage our state's debt that will ultimately help to protect and strengthen the state's creditworthiness, a policy objective on which I believe we can all readily agree. The question is how we can best achieve that objective in order to serve the long-term best interests of our state and its citizens. Today, I will discuss the policy implications of using bond premiums and the manner contemplated by the bill, and that is to reduce overall debt levels and long-term debt costs. My remarks will precede a more detailed but brief PowerPoint presentation on bond premiums by Sarah Sanders, Assistant Treasurer of Debt Management, and Josh Nikita, Managing Director with Acacia Financial Group, an independent financial advisory firm that assists the state on its bonding program. Under Senate Bill 1133, premiums on general obligation bonds, which we commonly refer to as GO bonds, would be used after payment of costs related to issuing these bonds to fund previously authorized capital projects. In this way, the amount of bonds that would need to be issued to fund a given set of capital projects would be reduced. Now, bond premiums are upfront cash payments to the state by investors in exchange for the state paying a higher interest rate on a given bond. Each time my office issues bonds, we first analyze market conditions to determine how to structure bonds so the sale is a success. In a low interest rate environment, as has been the case for several years now, investors prefer to buy bonds with a higher interest rate and thus are willing to pay a premium to avoid certain federal tax consequences. So, to maximize our bond sales, when the market demands it, we include bonds that offer a premium pricing component. To illustrate how premiums work, here's a personal financial analogy. Take, for example, a car dealership that offers a consumer a financing package of either $1,000 cash back for a 3% interest rate on a loan, or no cash back and a loan at a rate of 1.5%. That $1,000 cash back is similar to a premium payment that the state receives, a premium payment in exchange for the payment of a higher interest rate over the loan term. Now, when evaluating the economics of both transactions, the net impact is virtually the same. In other words, the present value of the total payments over the life of the higher interest loan less the cash back is equivalent to the present value of the total payments of the lower interest with no cash up front. Taking the analogy further, under current state law, the $1,000 cash back is earmarked by the borrower to pay interest on the car loan over the next 18 months. But a better use of that $1,000 would be to use it to help pay for the price of the car so the consumer borrows less. This would lower the amount of debt and lower the monthly car payments. The car analogy is essentially what Senate Bill 1133 would do. Use the GO bond premiums to fund capital projects, which in turn would reduce the state's high debt levels and future debt service costs. Our GO bond program is by far the largest bond program my office manages, and therefore it generates the most bond premiums. This bill would make our GO program conform with other smaller bond programs for transportation, Yukon, and clean water, where premiums are in fact used to fund capital projects and thereby reduces the dollar amount of bonds issued. The legislation I propose is in the best interest of current and future generation of taxpayers. It represents a better practice for the use of premiums in a low interest rate environment. Now, when we're not in a low interest rate environment, then it would not be wise, it would not be prudent to have a premium pricing component to our bond structure. This legislation is consistent with responsible borrowing and stewardship of public resources. With that said, I strongly recommend passage of this bill, but with an amended effective date of July 1, 2017. This would allow the state time to adjust to the new practice from a budget perspective and hopefully encourage more of your colleagues to support it. Thank you for the opportunity to offer comments on the broader implications of this bill. Through you, Representative Berger, I now would like to turn the floor over to Sarah Sanders for a brief PowerPoint presentation.
Thank you, Treasurer, and good morning. I plan to move quickly through this presentation in the interest of time.
If you could again just please identify yourself for the record.
This is Sarah Sanders, the Assistant Treasurer for Debt Management.
Thank you.
Under current law for the General Obligation Bond Program only, premiums after the cost of issuance is deducted are deposited into the general fund. And then under federal tax law, we utilize those monies to pay up to 18 months of interest on the bonds. Now, because the bond premiums are deposited into the debt service budget line item, they contribute to budget lapses in the debt service line item, and this reduces the amount that the legislature needs to appropriate for debt service. This graph shows an 11-year history of bond premiums credited to the general fund debt service budget. Our office has previously never budgeted or projected bond premiums before they are received. Only the amounts that have been received prior to the budget being passed have been included in the budget. However, recognizing the very difficult challenge the General Assembly faces in crafting a budget this year, Treasurer Nappier instructed us to conservatively estimate how much bond premium we can expect over the biennium based on current capital market forecasts, and those estimates were provided to this committee. Now, this graph breaks out the amount of bond premium that was credited to the budget before the budget was passed and the amount that was credited following the passage of the budget, which contributed to the debt service lapses.
So I heard you say the blue bar represents premiums received before the budget was adopted. Okay. Yep. And the red line represents premiums received after the budget was adopted?
Now you can see the amounts have increased in recent years, and there are several factors contributing to this. The first is the expiration of the Build America Bond program, which I'm not sure if you're familiar with, but it was a federal program for municipal issuers to issue taxable bonds in lieu of tax-exempt bonds and receive a federal interest subsidy. But the result of that is in 2009 and 2010, we issued a lot of bonds under that program that received no premium because taxable bonds are generally sold with no premium at all. The second major factor is that interest rates are lower since the financial crash of 2008 and 2009. And as the Treasurer explained earlier, it's the fact that rates are so low and investors are concerned with rising interest rates that they demand the premium structure in the first place. And the third factor is that issuance has increased over time, thus increasing bond premium. Senate Bill 1133 would change the way GO bond premiums are used by applying them to fund projects previously authorized for bonding. This would reduce outstanding GO debt that we issue, as well as future debt service costs, and conform the program to the state's other programs. Treasurer Nappier did propose this same legislation back in 2005, and we calculated that had it passed at that time, our outstanding GO debt would be at least $420 million lower today. We have an example to help explain how the impact of Senate Bill 1133. And we took an actual bond sale from last December. It's a $300 million bond sale. The sale funded $300 million in projects, and it generated $37.7 million in bond premiums that were used to fund interest payments. The total debt service on the bonds over 20 years is $442.8 million. Net debt service, after accounting for the fact that we would receive the $37.7 million up front to pay interest, is $405.1 million. Had Senate Bill 1133 been in place, we would have only had to issue $267 million in bonds to fund the same $300 million in projects. This means we would reduce the debt on that bond issue alone by $33 million, or 11%. And total debt service would have been reduced to $393.5 million. So in summary, on this one bond sale alone, you can see that the debt issued could have been reduced from $300 to $267 million, or 11%. And this is probably the most important factor of Senate Bill 1133. In addition, total debt service on a nominal basis over the 20 years would have been reduced 11.6 million. You can just imagine how significant this impact would be going forward. Now I'd like to turn it over to Josh Nikita to talk a little bit more about premium bonds and the market for them.
Good morning. For the record, my name is Josh Nikita with the Acacia Financial Group. We're an independent financial advisory firm, and we serve as financial advisor to the Treasurer's Office in connection with the issuance of the GO bond program. I'm going to speak a little bit about bond premiums and why investors have a desire to invest their money in bond premiums. Bond premiums, as Treasurer Nappier mentioned in her opening remarks, are essentially upfront payments by investors to the state in exchange for the state paying a higher stated interest rate on a given bond compared to market rates. The premium amount is equal to the difference between a higher interest rate and what would have been paid at market rates. It's effectively upfront payments in exchange for a payment by the state over time on that bond. Excuse me. So why do investors want to buy premium bonds? Why are they interested in purchasing this type of investment? Well, in the current interest rate environment, premium bonds offer a number of advantages to investors versus par or more discount bond structures. First and probably most importantly, purchasing premium bonds allows investors to avoid certain onerous and potentially consequential provisions in the federal tax code, which could impact lower rate bonds if rates increase. In addition, premium bonds in general are less sensitive to rising interest rates, which is more likely in today's interest rate environment where we are at historically low rates. And finally, higher coupon bonds are more liquid than par or discount bonds. This essentially provides for a higher overall demand, and they're more able to be traded in the secondary market, giving investors the ability to trade those bonds and sell them to additional investors or purchase them from another investor. And for these reasons, in this current rate environment, bonds with a premium structure are very much in high demand compared to par or discount structures. What we'll see is once interest rates begin to rise, the premium structure will become less of an issue. We've seen this on prior transactions when there's been spikes in interest rates during the financial crisis. The state has realized less premium on the bonds. However, where we are today and based on this proposal, we believe this is the appropriate path forward for the state. And with that, I'd like to pass it back over to Sarah for some conclusion remarks.
Let me just add one comment. Thank you, Josh. I just want to add one comment about that federal tax code to let you know that not only did we put before the legislature, and I believe this committee, a proposal that would have allowed us to use bond premiums in the same manner that we're now using them for the smaller bond programs, but we also approached the federal government, Congress, and sought to change the federal tax code.
I believe that letter was provided to this committee. Sorry about that. Bond premiums are prevalent in the municipal bond market. This proposal would require premiums on GO bonds to be used to fund capital projects, just like the state's other bonding programs. And this represents a better practice in the efficient management of the state's debt in a low interest rate environment, and we feel that it's consistent with responsible borrowing practices. We'll be happy to take your questions.
Questions or comments from committee members? Senator Franz.
Thank you. Thank you to all three of you for your presentation this morning. Question on the marketability in the secondary markets and some of the potential tax implications. You sort of implied that that with a sale of a bond in existence before it matures, if you have paid a lot more for it, you may be incurring a larger capital gains tax burden. Is that what you were saying?
No, not exactly.
Okay.
The federal tax code complications and potential negative impact to an investor would occur when you're purchasing a par or a discount bond structure. The federal tax, there's a de minimis provision in the federal tax code which requires the investors on a discount bond, if rates increase, to take that gain as a capital appreciation, so it's an additional tax consequence and penalty to that investor of the bond. Typically, they're buying tax-exempt bonds to avoid any tax consequences. By purchasing a par or discount bond structure in a low interest rate environment, there's a greater chance that they will eventually have to realize some capital gains, and that's a negative from an investor standpoint.
Okay, and so to avoid that, buying a bond at a premium is going to put you in a much better tax situation going forward.
That's exactly right. It's what's known as a defensive position from the investor. Yep. So they want to buy a 5% coupon bond when rates are at 2% because it's less likely that they'd reach that de minimis and have to pay that capital gains.
Okay, thank you for that. And secondly, what's the built-in limitation on how high a premium can get percentage-wise, either in the market or anything in the tax code that might come into play if the premium is too high? In other words, why don't we just sell bonds at 25%
right.
Coupon rate?
I think certainly the market demand is what's going to drive that coupon. In this market right now, we're seeing 5% coupons. Maybe you're seeing 5 1/4s, 5.50s, very rarely. As far as the federal tax code requirements in terms of limitations on it, premium bonds are when they're callable, they're priced to the call date. So an issuer would be punished for issuing bonds with excessive premium. It would be more costly to the state to do so, or for any issuer to do so. Therefore, there's a disincentive to issue bonds with an extreme premium. You want to try to minimize that to avoid those consequences and additional costs over time.
Thank you. That's very helpful. Thank you, Mr. Chairman.
Thank you. Madam Treasurer?
I just want to mention that there's a glossary of terms in the PowerPoint presentation, and we actually defined three different types of bond structures: par, premium, and discount. And what you'd be concerned about if you buy a premium, you don't want then to have it sell at a discount as the interest rates rise.
We good? We're good. Chair recognizes Representative Davis.
Thank you, Mr. Chairman, and thank you for this presentation. Certainly very helpful in understanding what's become quite the hot topic here in Hartford recently. I was just wondering, and I know that you mentioned that you put forward a similar proposal in 2005. Do other states approach bond premiums the same way?
Well, Connecticut's always ahead of the curve.
Got it.
They will. There are a lot of issuers right here in the state that use bond premiums, given the demand for it, and have the same practice as the state has with respect to its GO bonds. But the state really set the pace years ago when the smaller bond programs were treated in a manner that allowed us to use the premiums to pay cash for some of the authorized projects.
Josh and I have assembled some information on other states that we can share.
Yeah, we represent a number of states throughout the country, and we're familiar with how other states that we don't advise operate. And I would say, I don't know the actual statistics, but I do know of state of Ohio, state of Wisconsin, state of Alaska, the Commonwealth of Massachusetts, to name a few, that are permitted to use their bond premiums for capital projects. I would say it's probably more common than not to be able to do so.
Okay. And you mentioned during the presentation that municipal bond issuers oftentimes take premiums too. Is it a common practice by them to use it for capital as well, or do they use a similar structure like we do currently, where we use it towards the indebtedness cost, the interest rate cost?
I don't have factual evidence, but I did talk to one of our bond counsel who says that it's not uncommon for Connecticut municipalities to use premium to pay interest as opposed to funding a project, but in most cases they have flexibility.
So it would be on a town-by-town or issue-by-issue
Yes,
basis?
I don't
on
have
the
any
municipal
factual
level?
information. It's just an inquiry I placed with one of our bond counsel who represents a lot of municipalities.
Yeah, generally the state law will govern what the local municipalities can do with that premium. So it's probably a state-by-state basis on how the local governments manage their debt.
And just recently, Madam Treasurer, you issued a letter, I think it was last week, talking about need for some restraint on the bond premiums, or at least our forecasting of including them within the budget. And I was just wondering if you could kind of walk us through your thoughts on why perhaps adopting the large amount of premiums is not in the best interest of the state of Connecticut, or not most likely to be yielded on the market when we do issue these bonds in the coming 2 years.
We don't typically budget premiums that have yet to be received. And what we've done in this case, in an attempt to narrow the gap between the governor's recommended debt service budget and the treasurer's proposed budget, we've attempted to narrow the gap given the state's fiscal constraints. And so we've done a couple of things. We've taken another look at the budget, looked at our premiums that we have received, and we've added the premiums that we received since we issued the budget last August. That was a no-brainer. Mm-hmm. Then we looked at, based on current market conditions and where the Fed is on increasing interest rates, we decided it wouldn't be a terrific gamble to budget premiums. And so we have budgeted premiums for the next 2 years. In addition to that, we took a look at our variable rates and noted that given the persistently low interest rate environment, that we could take, we could come down a peg or so on the rates we had initially projected, and based on our experience so far in the market. So we now have an updated projection of our debt service requirements, and there is still a gap between the governor's recommendation and our proposal. And so we are strongly recommending the General Assembly to add back $178 million.
Over the 2 years?
That's over the 2 years. There was another factor here, and that was increased bond issuance from our understanding of last year, and then the governor's soft bond cap that reflected some adjustments to the figures. The increased bond issuance was offset by premiums, so the hit wasn't that bad. But that is the component that you will not see in OFA's projections. And interestingly, they did their calculations separate from my office's calculations, and we were very close, with the exception of contemplating an increase in our bond issuance. And of course, there's a debt service cost, so we had to reflect that, offset by premiums.
Thank you very much. That was my interpretation of what you wrote as well, and I appreciate you walking us through
Now,
here.
Can I say one thing?
Sure.
Else, we are recommending that the difference of $178 million be included in the budget as a debt service lapse line item.
The premium amounts.
The premium amounts, yes, the 178 million. And that is because from day one, my concern has been that we protect our reputation in the markets. To the extent that that line item still shows, then we will not have to go before the Financial Advisory Committee to seek permission to transfer funds from one account to another account in order to meet a debt service payment shortfall. You never hear about debt payments. They're paid automatically. I don't hear about them either. When I go before the if I have to go before the Finance Advisory Committee, that's headline risk.
Thank you, Madam Treasurer. No further questions.
Thank you, Representative Davis. Any other comments or questions from committee members? Representative Candelar.
Thank you, Mr. Chairman. Thank you for your testimony and bringing this bill forward for the Finance Committee. I appreciate the quantifying the 2005, what the 2005 savings would have been had we implemented it back then. I guess it was stated roughly about $400 million. One of my concerns is that, and I think it was pointed out, we're starting to see an increase in premiums, in part because, one, we're borrowing more, and also because of it's a function of the interest rates. Because of that, should we not be implementing this sooner, even if it does create some budgetary holes and constraints? Shouldn't this be something that we shouldn't delay?
Ideally, yes, but I'm being pragmatic, realistic. I think it's important that we get this proposal through the legislative pipeline favorably, and I can't count it right now. This is not the best of times, and so that's why we've offered to have this bill take effect July 1, 2017.
And I certainly appreciate that, because I think it can't be understated the importance of putting this legislation forward and making sure that, I guess it is a way that we do it is if we delay the startup date, it still would get implemented.
Yeah, and let me be just forthright, quite frank with you. A while ago, I was talking about the updated debt service budget as proposed by the Treasurer. That updated budget that reduces the gap between the governor's budget and the Treasurer's budget depends on the budgeting of premiums. So, in a nutshell, the passage of this bill will avoid ever having surpluses because we use premiums instead of general funds to pay interest. We would be using premiums to fund capital projects. Are you following me?
Right.
If this bill were to pass effective for the ensuing fiscal year, then the projected shortfall in the debt service budget would be $325 million, which was the original projection.
And if we, I know you proposed this in 2005. Is this a practice that we did 20 years ago or 30 years ago, or did this practice begin as a function of when we hit the recession in '03?
Okay, well, I've been managing debt for the state of Connecticut for 17 years. When I first came here, we sold bonds at par. It was pretty simple. Occasionally discounts. Sometimes we'd even have to ask for a little premium just to cover our cost of issue. That was 17 years ago. But the market has changed, and this has become a phenomenon. But for the last 10 years, we have been experiencing levels of premium, as we showed in this graph.
Page 3.
But years and years ago, bonds were just sold at par, pretty much.
Okay. And you had mentioned about debt service lapse, to record it in the budget as a debt service lapse. I sort of jumped up when I heard that. One of the concerns I have is a couple of years ago, we created a revenue lapse in the budget. And when we hear of the Appropriations Committee, they're always looking at savings on the expense side, and we budget that as a lapse. It makes sense. I get worried. I worried then when we budgeted revenue as a lapse, because it's basically telling DRS, go find more money. Without public policy, that's just disconcerting to me. So in terms of budgeting debt service as a lapse, so what would that mean?
In the event there was a shortfall, and let's say because rates go up, 2016, and I shouldn't say that because it could happen. If rates go up 2016, then the premiums that we budgeted but we had yet to receive, it's not there, because I'm not going to go to the market and issue bonds with a premium pricing component. We've never done that. We don't control the financial markets, we respond to it. Okay, so if the rate goes up, then we won't get the premium. It'll be a par bond. And therein lies the problem, because we'll have that shortfall. And it's, call it reputational risk, headline risk, but it'll be known publicly that we've had to we had to jump over a loop to a hurdle to meet debt service payments, and would be interpreted that the state is failing financially.
I see.
These bonds are deemed appropriated, so you can rest assured that the bondholder will be paid, and they will be paid on time. But it'll be an action that is exposed publicly, that there was some difficulty, and we had a hurdle to overcome in order to pay that debt service.
Thank you. And then just a final point. I was reading OPM Secretary Ben Barnes' written testimony that was submitted on this proposal. And he states that this bill, as currently drafted, would increase debt service appropriations by hundreds of millions of dollars compared to the governor's proposed budget. And I just wanted to put this on the record to be clear that this bill doesn't increase debt service appropriations necessarily. What it is you're creating a fiscal, a sound fiscal budgeting tool for the legislature, and it does not create debt service appropriations. Am I correct in that?
The most recent projections like the earlier ones, does require an add back to the governor's budget, an add back of $178 million.
Perhaps what he's referring to is like currently, you know, under the current practice, you get all this upfront payments, and it creates upfront savings in your debt service budget. But of course, it's at the expense of having higher debt service in the long term. So we would no longer be getting these upfront budget savings, but on the long term, it would be saving money and definitely reducing our outstanding debt.
Which is a better policy, obviously.
Yes.
And I guess that was just my point, to make it clear. I understand that potentially this proposal could delay by 2 years. It's not good fiscal policy. The best thing that we could do, I think ideally as a legislature, is to implement this policy yesterday, in an ideal world. So, thank you. I appreciate your coming today.
Thank you. Any other questions or comments from committee members? Seeing none, thank you for your presentation. Thank you for taking the time to testify before the committee. While we are waiting for the Madam Treasurer to clear out with her staff people,